Welcome to our comprehensive guide on how to become a successful DIY investor. In this video, we'll break down the essentials of managing your own investments, from understanding the basics to building a robust plan for your financial future. Whether you're a physician, a professional, or simply someone interested in taking control of your finances, this journey will empower you to make informed decisions. Let's start by exploring what it means to be a DIY investor and why so many people are choosing this path to financial independence. DIY investor or do-it-yourself investor is someone who manages their own finances without relying on a financial advisor. This approach requires a genuine interest in personal finance and investing, as well as the discipline to learn and apply key concepts. DIY investors take charge of their financial future, making decisions about asset allocation, investment strategies, and risk management. If you find personal finance even a little bit interesting, you're already on the right track to becoming a successful DIY investor. There are three main reasons people choose to manage their own investments. It's fun, it gives you control, and it saves you money. Many find the process of learning about investing and watching their wealth grow to be rewarding. Being in control means you make the decisions and avoid the risk of someone else mismanaging your money. Most importantly, you can save significant amounts in fees that would otherwise go to advisors. Over a lifetime, these savings can add up to millions of dollars, making DIY investing a highly lucrative hobby. If you're new to investing, it's best to start slowly. Begin by managing a small portion of your portfolio, such as your Roth IRA or 401k. Observe what your advisor does, ask questions, and gradually take on more responsibility as you gain confidence. Mistakes made on a small portfolio are inexpensive and provide valuable learning experiences. Over time, you'll find managing your own investments becomes easier and more intuitive. Succeed as a DIY investor, you need to learn the basics of personal finance and investing. Focus on understanding your own retirement accounts, such as your 401k, and the options available within them. Read plan documents, compare investment options, and familiarize yourself with fees. You don't need to master every aspect of tax law or investing, just the parts that apply to you. Supplement your learning with books, blogs, podcasts, and online forums. The more you engage with these resources, the more natural financial concepts will become. Understanding market history is crucial for DIY investors. Markets experience regular corrections and bear markets, but these downturns are normal and should be expected. For example, from 1900 to 2013, there were 123 corrections and 32 bear markets. If you have a long investment horizon, you'll likely encounter many of these events. Learning about market history helps you stay calm during downturns and stick to your investment plan, knowing that volatility is part of the journey. For most people, investing is not optional. To achieve reasonable financial goals, you must invest in assets with some risk, such as stocks or real estate. Riskless assets like bonds or CDs typically don't offer high enough returns to meet retirement needs unless you save an extremely high percentage of your income. Embracing investment risk is essential for growing your wealth and reaching your long-term goals. Investment risk comes in two main forms: shallow risk and deep risk. Shallow risk refers to the short-term volatility in your portfolio's value, which can be unsettling but is usually temporary. Deep risk, on the other hand, involves permanent loss due to factors like inflation, deflation, or inadequate savings. While many worry about market swings, the biggest risk is often not saving enough. Fortunately, your savings rate is entirely within your control. Setting clear financial goals is a foundational step for any DIY investor. Start by estimating how much income you'll need in retirement, subtract any guaranteed sources like pensions or Social Security, and multiply the remainder by 25 to find your target nest egg. From there, calculate how much you need to save each year, considering your current savings, time horizon, and expected investment returns. Adjust your plan as needed, but having a concrete goal will keep you focused and motivated. Asset allocation is the process of deciding how to divide your investments among different asset classes, such as stocks, bonds, and real estate. Simple, diversified allocation might look like 25% US stocks, 25% international stocks, 25% real estate, and 25% bonds. The key is to choose a mix that balances your need for growth with your ability to tolerate risk. Write down your plan and the reasons behind it so you can refer back to it during market downturns. Once you've set your goals and chosen an asset allocation, it's time to implement your plan. Take advantage of tax-advantaged accounts like 401(k)s and IRAs and make regular contributions. Allocate your investments according to your plan using index funds or other low-cost options. Remember, the exact setup will depend on your personal situation, but the principles remain the same: diversify, minimize fees, and stay consistent. Automation is a powerful tool for DIY investors. Set up automatic contributions to your investment accounts and automate rebalancing where possible. This reduces the temptation to time the market and helps you stick to your plan. Maintenance involves making regular contributions, purchasing additional shares, and occasionally rebalancing your portfolio to maintain your desired asset allocation. Most of the work is done up front, and ongoing management can be largely automated. Most important aspect of successful DIY investing is sticking with your plan through all market conditions. Emotional reactions to market volatility can lead to costly mistakes, such as selling low during downturns. Remind yourself of your long-term goals and the reasons behind your asset allocation. If you find it difficult to stay disciplined, consider seeking support from online communities or a fee-only advisor for occasional guidance. There are many resources available to help you on your DIY investing journey. Books, blogs, podcasts, and online forums offer valuable education and support. Some recommended resources include the White Coat Investors books, financial boot camps, and online communities. Engaging with these resources will deepen your understanding and connect you with others who share your goals. Remember, continuous learning is key to long-term success. Becoming a DIY investor is a journey that starts with curiosity and grows with experience. By taking control of your finances, setting clear goals, and sticking to a disciplined plan, you can achieve financial independence and security. Remember, you don't have to know everything to get started. Just focus on what applies to you and keep learning along the way. With the right mindset and resources, you can confidently manage your own investments and build lasting wealth.